The 4 Laws of MACD. Welcome back to Trader DNA. Today we're unlocking the ultimate cheat code for trading, the 4 Laws of MACD. This video is about to change the way you trade forever. These 4 laws are the game changers that big traders and institutional traders use to dominate the market with the MACD, Moving Average Convergence Divergence indicator. We're talking about decoding the market's trends and momentum like you've never seen before. And here's the deal. If you stick around until the end of this video, you'll walk away with a master level understanding of MACD. You won't just be following the market, you'll be leading it. No more confusion, no more hesitation. You'll be trading with the same confidence and precision as the biggest names in the game. Listen, and let me tell you, if moving averages are the mother of all indicators, then MACD, it's the father of all indicators. That's right, this indicator is an absolute legend. So I'm convinced that after this video, you'll know exactly how to use MACD in any market with any strategy on any time frame. You'll be combining it with other tools and strategies like a trading ninja. All right, let's get started and break down the 4 laws of MACD step by step. Let's go. Now, I know what you're thinking. What's so special about these laws? Let me tell you, once you learn these, you'll be trading like a pro in no time. This isn't just theory, this is the real deal that the top traders rely on every single day to stay ahead of the game. Law 1, MACD crossover. This is the most crucial signal in MACD trading, and it's the first thing big traders and institutional traders look at. Why? Because the MACD crossover is a massive indicator of what's about to happen in the market. I'll show you why ignoring this is like leaving money on the table. And you don't want to miss this. Law 2, MACD divergence. This is where the magic happens. Divergence is the hidden signal that the market is about to make a huge move. I'll reveal how big traders and institutional traders spot these signals before the rest of the world even knows what's coming. Get ready to see the market in a whole new way. Law 3, MACD histogram reversal. This is your early warning system for trend reversals. Experienced traders use the MACD histogram to spot trends before they happen, and now so can you. I'll show you how to catch these reversals before anyone else, and trust me, this one's a game changer. Law 4, MACD support and resistance. Combining MACD with support and resistance levels takes your trading to the next level. This technique is the key to making your signals super accurate and unbeatable. You'll learn how to use this combo to dominate any market, anytime. These 4 laws of MACD are the must-know rules for anyone serious about trading. Stay with me, because we're about to break down the first law, MACD crossover, and you're going to want to pay close attention. This could be the most important trading lesson you've ever had. Law 1, MACD crossover. Alright traders, this is it. We're jumping into Law 1, the MACD crossover, and if you've been looking for a strategy that's both simple and super effective, this is the one. It's not just popular, it's one of the most reliable tools in the trading world. The concept, when the MACD line crosses the signal line, it's your cue to take action. Let's break it down. The MACD line comes from subtracting the 26 period EMA from the 12 period EMA, and the signal line? That's a 9-period EMA of the MACD line. It might sound technical, but trust me, once you get it, you'll see why this crossover can boost your trades like nothing else. Here's the deal. Buy signal, bullish crossover. When the MACD line crosses above the signal line, it's a strong sign that the price momentum is moving up. This is your moment to buy or open a long position. Sell signal. When the MACD line drops below the signal line, it signals that the momentum is heading down. That's your chance to sell or open a short position. This isn't just some random strategy. It's the foundation that many top traders use to make their moves. And the best part? You can customize it. Use shorter periods for quick trades or go longer if you're in for the big wins. Why you need this strategy? 1. It's simple and accurate. This strategy is loved by professional traders because it's straightforward and reliable. You don't need to overthink it, just watch those 2 lines in your set. Plus it works great with other tools, keeping your mind sharp and your decisions on point. 2, it thrives in clear trends. Whether the market's going up or down, this strategy helps you ride the momentum effectively. Here's an example of the MACD crossover in the market. From this, you can see a bearish crossover followed by a price drop, then a bullish crossover with the price gradually rising, then another bearish crossover followed by a bullish crossover, and so on. It's very simple but powerful. Once you master this, you'll see how much it can elevate your trading game. How do professional traders spot those high probability MACD crossover signals? This is the game changer that separates beginners from the pros when using the MACD crossover signals. The big traders and institutional traders, those seasoned pros, are super disciplined in every trading rule they follow, and the MACD indicator is no exception. Here's the secret. The market's movement needs to be clearly readable before you even think about using the MACD crossover signals. Look at this chart. This bearish crossover signal right here is what pros call a high probability signal. Why? Because if you check the previous movements, the MACD has been on point with tracking the price. But when the market gets all choppy and unreadable, like over here, the pros, they just ignore the MACD crossover signals until things smooth out and become readable again. Are you with me? This is a game-changing rule for mastering the MACD, so if you're serious about stepping up your trading game, don't brush off these guidelines. They're your tickets to trading like a pro. Law 2, MACD divergence. Alright, let's dive into the MACD divergence. This thing is a total game changer for spotting trend reversals and momentum shifts in the market. What makes it so cool? Well, it homes in on the gap between the price action and the MACD indicator, tipping you off when a trend might be weaker than it looks, or when it's about to flip directions. So here's the deal. This strategy is all about catching those subtle differences between where the price is moving and what the MACD is doing. And trust me, this is gold for giving you an early heads up before the market actually turns. It's like having a crystal ball that lets you jump into or out of trades right on time. Now let's talk about the two types of MACD divergence you need to know. Bullish divergence. This is where the price makes a lower low, but the MACD histogram is like, nope, I'm making a higher low. It's telling you that even though the price is dropping, the selling pressure is fading, and bam, the trend could flip upwards any second now. Bearish divergence. On the flip side, we've got the price hitting a higher high, but the MACD histogram is playing it cool with a lower high. What's happening? The buying momentum is running out of gas, and it's waving a red flag that the trend might crash downwards soon. Alright, let's break down how the MACD divergence strategy works. Step 1. Identifying the divergence. This is where traders need to lock their eyes on the price movement and the MACD indicator. It's all about catching those key moments when the price and the MACD histogram or signal line start moving in opposite directions. Trust me, it's like finding treasure on the chart. Step 2, confirming the reversal. Now this part is super crucial. After spotting that divergence, you got to wait for solid confirmation of a trend reversal. And how do we do that? By looking for reversal candlestick patterns, or even better, a trend line breakout. Here's the secret sauce. Combining MACD divergence with a trend line breakout is a simple yet insanely powerful move. Let's jump into an example. Take a look at this chart. After a bearish divergence forms and the price breaks below the bullish trend line, boom, that's your high probability signal that the trend is about to go bearish. And if you're wondering, where should I set my stop loss? Easy. Place it just above the highest point of that bearish divergence formation. Now check this out on the next chart. When a bullish divergence pops up and the price smashes through the bearish trend line, it's time to buy with confidence. And for your stop loss, stick it right below the lowest point of that bullish divergence formation. Simple, powerful, and super effective. So what are the advantages of the MACD divergence strategy? Trust me, you don't want to miss this. First up, early signals. The MACD divergence is like having a crystal ball that gives you a heads up before a trend reversal happens. This is huge. It means you can jump in before everyone else and ride that wave to the top. But here's the thing, getting in early can be risky, like really risky, because you might get in too soon. That's why the pros use a secret weapon, the trend line. Yeah, you heard me. Pair the MACD divergence with a trend line and bam, you've got a strategy that's next level powerful. Just like I showed you, this combo helps confirm those early signals and keeps you from making bad trades. Now, the big traders and institutional traders, they love this. They use the MACD divergent to the heads up, a little nudge that says, hey, something big's about to happen. And they've got plenty of time to plan their next move, especially when they're playing with those big time frames like daily, weekly, or even monthly charts. They don't just react, they strategize. That's how they stay ahead of him. And here's the kicker. It works in all market conditions. Whether the market's trending or just chilling in a range, the MACD divergence is there, giving you the signals you need to stay on top. Law 3, MACD histogram reversal. Alright guys, let's dive straight into the MACD histogram and uncover how this bad boy can help us spot potential market reversals like a pro. The MACD histogram isn't just a random graph, it's your secret weapon for measuring the difference between the MACD line and the signal line. It's all about momentum, and when that histogram flips direction, boom, it's giving you a heads up that the current trend might be losing steam, and a reversal could be right around the corner. How the MACD histogram works. Think of the MACD histogram as a visual power meter. Each bar shows how far the MACD line is from the signal line, above or below. When these bars grow, it's like the market saying, hey, I'm picking up speed. But when the bars start shrinking, it's a big red flag saying, uh-oh, we're slowing down. Spotting those reversals. 1, bullish reversal, let's go up. Picture this, the histogram has been negative, but then it starts shrinking and flips to positive. That's the market whispering. Bears are tired, the bulls are coming. This is your cue that a bullish trend could be kicking off any moment. 2, bearish reversal, time to slide down. Now, when a positive histogram starts to shrink and turns negative, it's like the bulls are packing up and the bears are gearing up for a takeover. This is your signal that a bearish trend might be about to slam the market. The MACD histogram reversal process. Step 1, watch that histogram. Keep your eyes glued to the histogram. If it goes from negative to positive, that's your green light for a potential buy. And when it flips from positive to negative, you guessed it, that's a sell signal. Step 2, lock in that confirmation. Don't just jump in. Wait for extra confirmation like a juicy reversal candlestick or some strong support and resistance levels to back up your move. Now check this out. In this chart, you'll see the MACD histogram going from negative to positive. Classic sign of a market reversal from bearish to bullish. The price rises, pulls back, and then bam, a bullish pin bar shows up. This is your golden ticket, a confluence between the MACD bullish reversal and the bullish pin bar, screaming, buy now. Set that stop loss at the lowest point where the histogram started to flip. But wait, there's more. As the trend skyrockets, the bullish histogram turns bearish, and at the same time, a bearish engulfing pattern pops up. Another confluence. This is your cue to sell with the stop loss at the highest point when the histogram switches from positive to negative. This strategy is fire. Alright guys, let's jump into why the MACD histogram reversal strategy can seriously level up your trading game. And don't worry, I'm going to keep this super clear and easy to follow so you'll be ready to use it like a pro. 1. Early reversal signals. Get ahead of the game. The MACD histogram is like a heads up for trend reversals. It gives you early signals so you can make your move before the big trend even starts. Imagine knowing when the market's about to flip before anyone else. It's like having a cheat code to get in or out just in time. 2. Measuring momentum. Know when the market's losing power. This strategy is a momentum detector. When a negative MACD histogram starts shrinking and flips to positive, it's telling you the bearish momentum is slowing down. And when a positive histogram shrinks and goes negative, that's your sign the bullish momentum is running out of steam. Knowing this lets you time your trades perfectly. Conclusion, a powerful tool for traders. The MACD histogram reversal strategy helps you spot trend reversals before they fully happen. It might have some drawbacks, but when you mix it with other indicators and use solid risk management, it becomes a powerful tool to dominate different market conditions. Law 4, MACD support and resistance. Alright guys, this strategy is going to blow your mind because it combines two powerful tools, MACD and support and resistance levels. Let me break it down so you can see why this combo is a total game changer for your trading. So what's the deal with MACD support and resistance? It's all about using the momentum signals from the MACD indicator in those crucial areas where price tends to stall or reverse, giving you way more accurate trading signals. Step 1, identifying support and resistance levels. Before we even think about using MACD, we need to find those key support and resistance levels on the price chart. Support is where the price usually stops falling and might bounce back up, while resistance is where the price often stops rising and could reverse downward. These levels are like the battlegrounds of the market. Step 2, using MACD signals. Once we've got those levels locked in, it's time to bring in the MACD for buy or sell signals. Buy signal, bullish. Picture this, when the MACD line crosses above the signal line near a support level, that's our cue. It's a strong signal that the price is ready to bounce back and continue upward, especially if we're in a bullish trend and the price is retesting the support. This is our golden opportunity to jump in. Sell signal. Now flip it. When the MACD line crosses below the signal line near a resistance level, it's time to think about selling. This tells us the price is likely to drop back down, continuing a bearish trend after hitting that resistance. It's like the market is giving us a heads up to get out before the fall. By combining these MACD signals with support and resistance levels, you're not just guessing, you're making smart strategic moves based on the market's momentum and key price zones. This strategy is a total game changer, and it's going to help you make way more informed trading decisions. Alright guys, we're diving into how you can use the MACD plus support and resistance strategy to make some serious trading moves. Stick with me because I'm going to make this super clear and exciting. Position entry, when to jump in. Imagine this. You've got the MACD giving you a buy signal and it's happening right near a support level. That's your cue to go long. On the flip side, when MACD gives a sell signal near a resistance level, it's time to go short. Easy, right? Let's check out some examples to see this in action. Here's the deal. We first pinpoint the support and resistance zones. The price drops down to a support area, and then we switch over to the MACD. Boom! The MACD line crosses the signal line from below. This is prime time to enter a buy position. Set your stop loss just below the support to keep things safe in case the price turns bearish. Now let's flip to another chart. We've got a strong resistance area locked in. The price heads up toward that resistance and starts to fall back. This is where we shift to the MACD again. When the MACD line crosses below the signal line, that's our sell signal. Place your stop loss above the resistance to keep your risk in check. And guess what? The price drops like a rock. That's the power of Law 4, MACD plus support and resistance. Stick to these rules and you'll be nailing high accuracy trading signals. The advantages. Why is this strategy so awesome? Double confirmation. That's right. When you combine the MACD with support and resistance, you get not one, but two confirmations for your trading signals. And what does that mean? Way fewer false signals. So you're not just shooting in the dark. Capturing momentum and key levels. This strategy helps you ride the big market waves and hit those important price levels. It's like having a roadmap to success, making your trades way more likely to succeed. But hey, nothing's perfect, right? Let's check out the disadvantages. Complexity and identification. Finding the right support and resistance levels can be tricky. It takes some practice, and if you mess it up, the whole strategy could go sideways. But don't worry, with time you'll master it. Lagging indicator. Yeah, MACD is a lagging indicator, which means it might be a little slow. Sometimes it could make you miss the start of a big move. But hey, better late than never, right? So, what's the final verdict? The MACD plus support and resistance strategy is a game changer. It mixes momentum with crucial price levels, giving you double confirmation and reducing false signals. Plus, with proper risk management, This strategy can seriously boost your trading results. Alright, that's it for today. Make sure to like, subscribe and hit that bell icon so you never miss out on our next trading hack. And remember, knowledge is power, but only if you use it. See you in the next video.